The imposition of a comprehensive U.S. naval blockade on Venezuelan oil tankers, announced on December 16, 2025, marks a critical escalation in efforts to control global energy flows amid eroding dollar dominance in commodity trades. This action, targeting exports primarily to China, seeks to reclaim Venezuelan oil reserves for American interests, disrupting established supply chains and intensifying economic pressures on Caracas. As Venezuela's production plummets and tanker seizures mount, the move underscores vulnerabilities in the petrodollar system, where non-dollar settlements have proliferated among BRICS nations. Right now, this intervention risks sparking retaliatory measures from aligned powers like Russia and Iran, potentially inflating global oil prices and straining refining capacities in key markets. Beneath the surface lie broader consequences: fragmented energy architectures that could accelerate de-dollarization, elevate borrowing costs for the U.S., and expose emerging economies to liquidity shortfalls. Stakeholders must navigate this unfolding crisis with precision, as miscalculations could cascade into widespread market instability and geopolitical realignments. As the geopolitical landscape of global energy security undergoes rapid reconfiguration, on December 26, 2025, the United States' enforcement of a naval blockade against Venezuelan oil assets emerges as a decisive maneuver in the broader contest for dominance over hydrocarbon flows and monetary architectures. Initiated with a formal declaration by the U.S. administration on December 16, 2025, this blockade explicitly targets all sanctioned oil tankers entering or departing Venezuelan ports, representing an unprecedented escalation in sanctions enforcement that extends beyond financial penalties to direct maritime interdiction. Public pronouncements from high-level officials have framed this action as a reclamation of oil rights allegedly expropriated from American entities, invoking historical grievances tied to Venezuela's nationalization efforts in the 1970s and subsequent asset seizures under the Maduro regime. By mid-December, operational implementations have included the pursuit and seizure of multiple vessels, such as the Panamanian flag tanker intercepted by the U.S. Coast Guard on December 20, and subsequent chases that forced supertankers to execute U-turns or retreat into international waters, culminating in a reported 76% plunge in Venezuelan crude exports compared to prior monthly averages. These interdictions, conducted under the auspices of expanded Coast Guard deployments in the Caribbean, have disrupted logistics chains critical to Venezuela's shadow fleet, a network of aging and often reflagged vessels designed to evade prior sanctions. The blockade's immediate tactical execution involves real-time tracking via satellite and naval assets, with reports indicating that at least 3 tankers have been boarded and diverted since the announcement, including one on Christmas Day, December 25, which was seized while in ballast, marking the 3rd successful operation in this intensified campaign. This operational footprint not only amplifies pressure on Caracas, but also signals a shift toward kinetic enforcement, where verbal directives are backed by physical presence, compelling vessels to alter courses and abandon loading operations at key terminals like José and Puerto La Cruz. Geopolitically, this blockade constitutes a frontal assault on Venezuela's entrenched alliances with China and Russia, entities that have provided lifelines through investment, military support, and alternative trade mechanisms that circumvent U.S.-dominated financial channels. By zeroing in on shipments predominantly destined for Chinese refineries, accounting for approximately 80% of Venezuelan exports in the 3rd quarter of 2025, the U.S. aims to sever these non-dollar trade routes, which have proliferated under bilateral agreements allowing settlements in renminbi or rubles, thereby eroding the petrodollar's primacy in energy transactions. Beijing's sharp rebuke, labeling the actions as an abuse of long-arm jurisdiction and a violation of international law, underscores the proxy dimensions of this confrontation, where Venezuela serves as a battleground for broader Sino-American rivalries over resource access and monetary influence. Similarly, Russia's extension of oil cooperation agreements with Venezuela, spanning 15 years and involving joint ventures in the Orinoco Belt, faces direct disruption, potentially straining Moscow's ability to leverage Venezuelan heavy crude as a hedge against its own sanctioned exports. The blockade's invocation of the Monroe Doctrine rhetoric revives hemispheric dominance assertions, positioning the U.S. as a gatekeeper in Latin America while risking escalatory responses, such as increased Russian naval patrols in the region or Iranian-linked tanker provocations, which could draw in addition actors and heightened tensions in strategic chokepoints like the Strait of Hormuz. United Nations experts have condemned the measure as aggressive, warning of humanitarian repercussions in Venezuela, where economic isolation could exacerbate migration flows northward, further complicating U.S. border management amid ongoing domestic fiscal strains. This alignment of forces illustrates a multipolar challenge to U.S. hegemony, where the blockade not only isolates Maduro, but also tests the resilience of alternative geopolitical blocs, potentially fragmenting global energy governance into competing spheres. Economically, the blockade exploits Venezuela's acute dependence on oil revenues, which comprise over 90% of its foreign exchange earnings, to precipitate a controlled collapse that might catalyze regime transition without direct military engagement. With production already hampered by years of underinvestment and sanctions, averaging around 784,000 barrels per day in November 2025, despite a slight uptick, the interdictions have stranded an estimated 11 million barrels offshore, forcing black market buyers to demand steeper discounts, potentially up to 50% below benchmarks, to offset seizure risks. This revenue squeeze intensifies fiscal distress in Caracas, where hyperinflation and currency devaluation have eroded domestic stability, compelling the government to resort to overborrowing from local banks, thereby creating adverse feedback loops that amplify sovereign debt vulnerabilities and constrain social spending. Policy's design leverages these weaknesses to undermine Maduro's patronage networks, which rely on subsidized fuel and food imports financed by oil proceeds, potentially fostering internal dissent and facilitating a negotiated exit. However, the blockade's ripple effects extend to U.S. interests, as exemptions for American refiners, importing robust volumes under prior waivers, highlight a selective enforcement that preserves domestic supply chains while targeting adversarial flows. Broader implications include the devaluation of Venezuelan crude on global markets, where heavy sour grades face quality mismatches with refineries optimized for lighter blends, prompting shifts in sourcing that could elevate costs for end users in Asia and Europe. Market behavior in the wake of the blockade reveals acute disruptions, with tanker freight rates surging by as much as 30% due to mandatory rerouting and elevated war risk insurance premiums that have doubled for vessels traversing the Caribbean basin. West Texas Intermediate crude futures experienced a 1.5% uptick immediately post-announcement, reflecting trader premiums for geopolitical risk, though OPEC's spare capacity, estimated at over 5 million barrels per day, has tempered broader price spikes by signaling readiness to compensate for lost Venezuelan volumes. Nevertheless, specialized refiners in China, reliant on Venezuelan heavy crude for complex processing, confront liquidity mismatches as alternative suppliers like Canada or Mexico command higher prices, potentially inflating diesel and fuel oil costs in downstream markets. Financial indicators, including a dip in Venezuelan bond yields amid heightened default risks, underscore investor wariness, with spreads widening by 200 basis points since mid-December. These dynamics foster a risk-averse environment, where hedge funds amplify volatility through speculative positions, contributing to erratic swings in energy equities and prompting central banks in import-dependent economies to bolster reserves against inflationary pass-throughs. Concealed within this enforcement regime are profound systemic risks that could accelerate the petrodollar's erosion, as enforced dollar settlements alienate trading partners and incentivize diversification toward alternative currencies and payment systems. The blockade's focus on quarantining Venezuelan oil inadvertently highlights the petrodollar's fragility, where reliance on U.S.-controlled clearing mechanisms exposes vulnerabilities to unilateral actions, prompting nations like China to deepen renminbi-denominated energy trades and expand swap lines with BRICS counterparts. Unintended boosts to OPEC members, such as Saudi Arabia and the UAE, may stabilize short-term prices but fragment traditional alliances, as these producers capitalize on market share gains while quietly diversifying reserves away from dollar assets amid U.S. fiscal uncertainties. In Venezuela, the blockade exacerbates domestic overborrowing, with local banks absorbing sovereign debt at unsustainable levels, risking banking sector insolvency and currency collapse that could spill over into regional economies through migration and trade disruptions. Globally, abrupt capital outflows from emerging markets exposed to energy volatility loom large, as policy divergences, such as U.S. tariff escalations, trigger flight to safety, amplifying inflationary pressures and constraining growth in import-reliant nations. As interdictions continue, with the U.S. pursuing additional tankers and Venezuela enacting penalties for blockade supporters, the action underscores a precarious balance. While aimed at regime pressure, it may hasten a multipolar energy order, diminishing U.S. leverage and fostering fragmented architectures that elevate long-term instability. Intelligence assessments must prioritize monitoring vessel movements and reserve shifts, as these developments unfold with potential to reshape global equilibria in real time. In the rapidly evolving arena of global energy geopolitics, as of December 26, 2025, the United States' imposition of a naval blockade on Venezuelan oil shipments represents a calculated reinforcement of the petrodollar system through assertive control over critical trade routes, particularly those channeling crude to non-compliant markets. By explicitly targeting vessels laden with Venezuelan oil en route to China, which has absorbed approximately 80% of Caracas exports in recent quarters, this blockade seeks to mandate dollar-denominated settlements in a domain increasingly contested by alternative currencies and bilateral pacts. The policy, announced on December 16, 2025, by the U.S. administration, extends beyond rhetorical posturing to include active maritime interdictions, with the U.S. Coast Guard and Navy deploying assets to enforce a comprehensive prohibition on sanctioned tankers entering or exiting Venezuelan waters. This enforcement has already resulted in the seizure of vessels, such as the Skipper, and subsequent pursuits that compelled supertankers to reverse course, effectively halving export volumes and stranding millions of barrels offshore. The strategic intent is evident. By disrupting these flows, Washington compels buyers to engage through U.S. sanctioned channels, thereby reasserting the dollar's centrality in energy transactions and countering the erosion driven by renminbi and ruble-based deals. Venezuela's oil, predominantly heavy sour crude from the Orinoco Belt, has been rerouted through shadow fleets to evade prior restrictions, but the blockade's kinetic dimension, marked by boarding operations and asset seizures, introduces a new layer of deterrence, compelling compliance or risking forfeiture. This approach aligns with broader U.S. efforts to reclaim expropriated assets from American firms, framing the action as restitution while simultaneously safeguarding the petrodollar's structural advantages in global finance. As this strategy unfolds in real time, it directly confronts the proliferation of bilateral agreements that have facilitated local currency trades, thereby diminishing U.S. leverage over sanctioned regimes. Venezuela's recent 15-year extension of oil cooperation with Russia, formalized in late 2024, exemplifies this trend, enabling joint ventures and settlements in rubles that bypass SWIFT and dollar intermediaries, insulating both nations from Western financial pressures. Similarly, China's absorption of over 400,000 barrels per day of Venezuelan crude in 2025, often settled in renminbi via offshore mechanisms, has bolstered Caracas' fiscal resilience while advancing Beijing's de-dollarization agenda through expanded cross-border interbank payment system usage. The blockade counters these arrangements by imposing physical barriers, forcing vessels to seek alternative destinations or face confiscation, as seen in the U-turns of multiple supertankers bound for Asian ports. This disruption not only curtails revenue streams essential to Maduro's regime, estimated at a 76% export drop by mid-December, but also signals to other producers the costs of non-dollar alignments. In the Western Hemisphere, where Venezuela's partnerships with BRICS entities challenge U.S. influence, the action echoes historical interventions like those in the 1980s Persian Gulf, aimed at securing oil routes and monetary primacy. Yet, Beijing's condemnation of the blockade as an overreach of long-arm jurisdiction and Moscow's warnings of reciprocal measures highlight the potential for escalatory cycles, where allied navies could contest enforcement in international waters, straining transatlantic alliances and complicating NATO's focus on Indo-Pacific theaters. United Nations experts' rebuke of the policy as aggressive underscores the humanitarian and legal frictions, potentially isolating the U.S. in multilateral forums and prompting neutral states to accelerate reserve diversification away from dollar assets. Geopolitically, the blockade asserts U.S. dominance in the Americas, invoking hemispheric security doctrines to counter multipolar encroachments from BRICS nations, which have invested heavily in Venezuelan infrastructure to secure resource access. Russia's stake, including debt for oil swaps totaling billions, faces direct jeopardy, as interdicted shipments disrupt Rosneft's operations and force rerouting through more costly SeaTic or Baltic pathways. China's interests, encompassing over $60 billion in loans tied to oil repayments, are similarly imperiled, with the blockade exacerbating tensions amid broader U.S.-China frictions over Taiwan and South China Sea navigation. This maneuver revives Cold War-era tactics, positioning Venezuela as a proxy in great power competition, where control over trade routes translates to influence over global supply chains. The policy's implementation, involving large-scale naval deployments, risks inadvertent clashes, as evidenced by Iran's historical tanker escort practices, potentially drawing Tehran into the fray through Houthi proxies in the Red Sea and amplifying disruptions to 20% of global oil transit. For Latin American neighbors, the blockade heightens migration pressures from Venezuela's economic deterioration, straining budgets in Colombia and Brazil while fostering anti-U.S. sentiments that could erode support for initiatives like the Americas Partnership for Economic Prosperity. In a multipolar context, this assertion of hegemony may galvanize BRICS cohesion, accelerating forums for non-dollar energy pacts and digital currency pilots that undermine the petrodollar's network effects. Economically, the enforcement of dollar usage through route control sustains vital U.S. advantages, including lower sovereign borrowing costs and substantial seigniorage revenues derived from global dollar demand in energy settlements. The petrodollar's recycling mechanism, whereby oil exporters reinvest surpluses in U.S. treasuries, has historically depressed yields by 5,100 basis points, facilitating deficit financing amid a national debt exceeding $35 trillion. By compelling Venezuelan crude to flow through dollar channels or face embargo, the blockade preserves this loop, countering the 3.5% share of global payments now captured by the renminbi in commodity trades. However, this comes at the cost of alienating key allies, as European refiners and Asian importers grapple with supply uncertainties, prompting retaliatory shifts in reserve compositions, such as Saudi Arabia's incremental renminbi holdings, that could elevate U.S. funding costs over time. Market reactions have been pronounced, with West Texas Intermediate crude rallying 1.5% in the immediate aftermath of the announcement, as futures contracts incorporated geopolitical premiums despite OPEC's spare capacity of over 5 million barrels per day mitigating outright shortages. Brent benchmarks similarly climbed, reflecting trader hedging against prolonged disruptions, though analysts project limited long-term price impacts given global gluts from U.S. shale and Guyana's ramp-ups. Freight rates for very large crude carriers have surged 20–30% due to rerouting demands, while insurance premiums for Venezuelan-linked voyages have doubled, compressing margins for shadow fleet operators and elevating operational risks. Underlying this reinforcement lie substantial risks that could precipitate liquidity mismatches and broader market instabilities, particularly for refiners attuned to Venezuelan heavy crude's unique properties. Chinese complexes, optimized for sour grades, face feedstock shortages estimated at 600,000 barrels per day, necessitating switches to costlier alternatives like Canadian oil sands or Middle Eastern blends, potentially spiking diesel and fuel oil prices by 10–15% in regional markets. This mismatch exacerbates supply chain vulnerabilities, as just-in-time inventories falter amid heightened shipping uncertainties, transmitting inflationary impulses to manufacturing hubs in East Asia. Moreover, the blockade accelerates transitions toward alternative energy sources, with European Union mandates for renewable integration gaining urgency as oil volatility underscores fossil fuel dependencies, potentially undermining long-term demand projections and stranding assets in producer nations. In emerging markets, abrupt capital outflows loom as energy price swings erode investor confidence, amplifying feedback loops in banking systems overburdened by sovereign exposures, as seen in Venezuela's domestic overborrowing cycles. These dynamics highlight the petrodollar's inherent vulnerabilities. While the blockade bolsters short-term control, aggressive policies may hasten fragmentation, fostering a multipolar monetary order where digital renminbi platforms and BRICS payment networks supplant dollar dominance, elevating systemic risks for U.S.-centric finance. The ongoing enforcement of this blockade illuminates a precarious juncture in international economic relations, where U.S. actions, though aimed at petrodollar preservation, inadvertently catalyze shifts toward fragmented systems that could redefine global trade architectures. As interdictions continue, with reports of additional seizures on December 25, the policy's efficacy hinges on sustained naval commitments, yet strains Pentagon resources amid concurrent commitments in the Pacific and Middle East. Venezuela's defiant claims of unaffected exports belie the reality of stranded cargoes and deepening discounts, pressuring Maduro's fiscal apparatus and potentially precipitating internal fractures that align with U.S. regime change objectives. For global stakeholders, this unfolding scenario demands vigilant portfolio recalibrations, hedging against currency mismatches and energy volatility that could cascade into broader financial turbulence. The blockade's ramifications extend to container shipping, where correlated disruptions in Venezuelan ports exacerbate global imbalances, delaying recoveries in supply-demand equilibria projected for 2026. Ultimately, as BRICS nations convene emergency consultations, the policy risks entrenching divisions, where retaliatory measures, such as accelerated gold, reserve accumulations, or non-dollar oil benchmarks, erode the petrodollar's foundational pillars, necessitating proactive intelligence monitoring to navigate the emergent multipolar equilibria. Amid the intensifying geopolitical frictions in the Western Hemisphere, as of December 26, 2025, the United States naval blockade on Venezuelan oil tankers has precipitated a marked escalation in volatility across global energy markets, with crude prices rebounding from multi-year troughs as immediate supply uncertainties eclipse the backdrop of persistent global oversupply. The blockade, formally declared on December 16, 2025, targets all sanctioned vessels entering or exiting Venezuelan ports, resulting in the interception and seizure of multiple tankers, including the Skipper on December 10 and the Bella 1 on December 21, both of which were en route to Asian refineries. This enforcement has compelled supertankers to execute U-turns or remain stranded offshore, effectively having Venezuelan crude exports from an average of 784,000 barrels per day in November to under 400,000 barrels per day by mid-December, according to tracking data from maritime intelligence firms. The resultant short-term supply risks have overshadowed the International Energy Agency's forecast of an 830,000 barrels per day increase in global oil demand for 2025, driven by improving macroeconomic indicators, pushing West Texas Intermediate futures up by approximately 1.5% in the days following the announcement and contributing to a weekly surge of over 6%, the largest since late October. Brent crude has similarly climbed, reflecting trader premiums for geopolitical disruptions, even as OPEC's spare capacity, exceeding 5 million barrels per day, offers a theoretical buffer against outright shortages. These price rebounds elevate operational costs for consumers and industries dependent on predictable energy inputs, such as transportation and manufacturing sectors in Europe and Asia, where diesel and fuel oil derived from heavy crudes like Venezuela's Maryblend face upward pressure on refining margins. By late December 2025, the blockade's disruptions have exposed critical vulnerabilities in specialized refining chains, particularly those calibrated for Venezuelan heavy sour crude, prompting extensive rerouting of cargoes and inflating freight rates amid heightened insurance premiums for vessels navigating the Caribbean basin. Chinese refineries, which absorb roughly 80% of Venezuela's exports under bilateral agreements settled in renminbi, now confront feedstock mismatches as alternatives from Canada or the Middle East command premiums of up to 15%, potentially cascading into higher downstream product prices across East Asian markets. Tanker loading at Venezuelan terminals like Jose has dwindled, with state-run PDVSA struggling to secure buyers willing to navigate the risks, leading to an accumulation of over 11 million barrels in floating storage and forcing black market discounts, as high as 50% below benchmarks, to offset seizure probabilities. Freight rates for very large crude carriers have surged by 20 to 30% due to mandatory detours and war risk surcharges, compressing margins for shadow fleet operators and transmitting cost increases to end users in import-dependent economies. This logistical strain exacerbates global supply chain imbalances, already under pressure from concurrent disruptions in the Red Sea and Panama Canal, where drought-reduced transits have diverted additional volumes to longer routes around the Cape of Good Hope, further elevating bunker fuel demands and operational inefficiencies. Geopolitically, the blockade fosters acute tensions with China, which has condemned the actions as an abuse of long-arm jurisdiction violating international law, while risking broader escalations involving aligned actors such as Iran, whose potential responses in the Strait of Hormuz could constrict up to 20% of global oil flows and amplify market instability. Beijing's reliance on Venezuelan imports, constituting 4 to 7% of its crude slate, prompt strategic diversification toward Middle Eastern suppliers, but at elevated costs that could feed into domestic inflationary pressures and strain bilateral ties with Washington amid ongoing trade frictions. Russia's condemnation of the seizures, coupled with its extended 15-year oil cooperation pact with Caracas, underscores the proxy dimensions of this confrontation, where disruptions to joint ventures in the Orinoco Belt threaten Moscow's hedging strategies against its own sanctioned exports. The United Nations human rights experts have declared the blockade illegal, affirming Venezuela's right to legitimate self-defense and highlighting humanitarian repercussions that could exacerbate migration flows northward, complicating U.S. border dynamics and regional stability. Iranian-linked tanker activities, drawing on precedents of escorts through contested waters, pose risks of symmetric responses, potentially elevating insurance rates for Persian Gulf transits and transmitting volatility to Asian and European importers reliant on those corridors. This web of alliances challenges U.S. hemispheric dominance, echoing Monroe Doctrine assertions, but inviting multilateral pushback that fragments energy governance into competing spheres, with BRICS nations accelerating non-dollar pacts to insulate against unilateral enforcements. Economically, market behavior manifests in proactive hedging against prolonged instability, as futures contracts embed geopolitical premiums, with implied volatility in oil options rising to levels not seen since early 2024 amid fears of supply chain fractures. Traders have positioned for upside risks, driving a 6.86% increase in crude prices since the blockade's onset, despite OPEC+'s commitment to production increases and non-OPEC supply growth, projected at 1.2 million barrels per day in 2026. Excess capacity within the cartel may cap near-term spikes, but it inadequately addresses crude quality mismatches, as Venezuelan heavy grades, essential for complex refineries, cannot be seamlessly substituted without reconfiguration costs exceeding $500 million per facility in some cases. This disparity sustains elevated spreads between light and heavy crudes, pressuring margins for U.S. Gulf Coast refiners exempt from the blockade under licenses, while amplifying pass-through effects to gasoline and distillate prices in domestic markets. Central banks in energy-importing nations, such as India and Turkey, are bolstering foreign exchange reserves to mitigate volatility, yet the blockade's proxy role in broader de-dollarization efforts, evidenced by Venezuela's ruble and renminbi settlements, erodes confidence in petrodollar recycling mechanisms. Lurking beneath these surface fluctuations are profound hidden risks, including abrupt capital outflows from emerging markets highly exposed to energy price swings, which could deplete reserves and trigger currency depreciations exceeding 10% in vulnerable jurisdictions like Brazil and Colombia. Amplified inflationary pressures in import-dependent economies, where energy constitutes 15 to 20% of consumer baskets, threaten to unwind recent disinflationary trends, compelling monetary authorities to tighten policy amid slowing growth trajectories, projected at under 2% for Latin America in 2026. Feedback loops in banking systems, overburdened by sovereign debt exposures in nations like Venezuela, where domestic absorption of bonds has surged amid fiscal distress, heighten the peril of contagion, as margin calls on distressed assets mirror those observed in Angola's bond tumbles earlier in 2025. These interlinkages extend to global financial architectures, where de-dollarization initiatives, accelerated by the blockade's coercive dollar enforcement, prompt reserve managers to diversify holdings, potentially elevating U.S. Treasury yields by 50 basis points and constraining Washington's borrowing capacity. The petrodollar's vulnerabilities, rooted in its dependence on recycled oil revenues into U.S. assets, face erosion as BRICS nations expand non-dollar oil benchmarks and digital currency pilots, diminishing seigniorage benefits estimated at $100 billion annually for the U.S. As this situation develops in real time, with U.S. F-22 Raptors deploying amid escalating Caribbean tensions and Venezuela enacting penalties against blockade supporters, these dynamics lay bare systemic fragilities in the international order, where actions ostensibly to preserve petrodollar dominance may instead catalyze profound realignments in global trade patterns. The blockade's humanitarian toll, condemned by UN experts for violating civilian protections, could drive further migration waves, straining fiscal resources in recipient nations and fostering anti-US sentiments that erode hemispheric cooperation. In energy markets, the paradox of geopolitical premiums amid structural oversupply, evident in the vanishing oil risk premium throughout 2025 despite multiple black swan events, signals a desensitization to disruptions, yet the blockade's focus on quality-specific crudes revives acute sensitivities. Emerging market sovereign bonds, already navigating tighter spreads from rebounding liquidity, risk renewed widening if outflows intensify, perpetuating cycles of overborrowing and fiscal erosion as observed in historical precedents. For multinational entities, this necessitates enhanced scenario planning, incorporating hedges against currency mismatches and supply rerouting costs that could add billions to annual expenditures. The broader erosion of petrodollar-centric architectures, accelerated by retaliatory diversification in OAPEC countries and beyond, portends a multipolar monetary landscape where reduced dollar intermediation heightens transaction frictions and undermines established safety nets. Intelligence assessments must prioritize tracking vessel movements, reserve compositions, and alliance shifts, as these elements coalesce to redefine economic equilibria in an era of contested hegemony.